Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review for the week ending February 6, 2026. So the title of the review this week is Tech Correction, because we are officially in a correction in technology. That means that the drawdown from the recent peak, which was in late 2025, is now more than 10%, so we're in correction. But in the software subsector, the pullback now, the drawdown is at about 30%. So we've had quite a shock for software. So there's many stories going on. They seem to be centered around Anthropic and their Claude agent. They published a few plugins this week, which seem to be going after a few businesses, especially for consultants, but also for software with the Claude code. It seems that it's getting much easier to just ask the AI to build any kind of software that we want. So it goes into the directly to attack the market of some software providers, just like, for example, Constellation in Canada. But we are hearing things about like Expedia.com, which is under attack as well. So the disruptive nature of AI is not really translating into productivity gains on the macro scale yet, but it is disruptive enough that it's starting to have some effects on some specific industries. So we'll discuss that in a few minutes. But before, maybe just a plug on our latest monthly, which was just released this week. The title is Living on the Edge. So this is in reference to the Aerosmith song. We look at the Dunroe Doctrine, so the new security strategy for the United States, and all of the implications that it entails. So, of course, if you remember, the Dunroe Doctrine is this security strategy in the US where basically they feel that the Americas, so North, Central, and South America, are the US's backyard, and their interests should dominate over there. Of course, that led to the situation with Greenland, that led to doubts about the future of NATO. So what does all of that mean? Well, it means more volatility, of course, more defense spending on debt, so more government borrowing around the world, and of course more demand for commodities, and what the world needs, Canada sells. So there's an opportunity there for Canada. So it's a very interesting read. We think it's an educational piece, so we recommend that you give it a read. And of course, if you have comments, we're always takers for those. So you have the address here at the bottom of the screen. Now, look at this week's markets at the close on a Thursday. So positive week for bonds, negative for stocks mostly. We had a positive week on the TSX and in Europe, a bit negative on the emerging markets, but still year to date, the order is emerging market first, Europe second, Canada third, and then after that the US, which is in negative territory, especially NASDAQ, which is at minus 3%. Oil down on the week, Canadian dollar, euro weaker. The USD was a bit higher on it. It seems to be the safe haven demand again. So the role of the USD as a safe haven is not completely dead. And the price of gold, very volatile. Last week we touched $5,500 rather. And this week, as you can see, we're closer to 4,800. Their pullback on Friday and on Monday, those 2 days combined, that was the worst pullback since 1980. So very volatile, but still up 10% year to date. We don't know if gold will be higher, stable, or lower in the short run, but we do think that it's going to be staying at a generally higher level. So playing the commodity itself right now might be tricky, but investing in gold miners, we still think that there's a good opportunity there because of the valuation of the sector versus the average level of the prices here. Still makes an interesting trade. Same thing also for metal producers like copper producers. So there are some good opportunities there. Of course, it's volatile, so you need to be aware of that before you get in. But we do feel that there's an interesting opportunities here, and that should support the TSX throughout the year. Now, maybe a little detour through a macro before going to the markets. Our leading indicator that we use, of course, I mean, we've used it often here. If you've seen us presenting on stage, we typically start with that. Our leading indicator is pointing to accelerating growth in the US and globally in 2026. That might be counterintuitive because of everything that we're hearing on the geopolitical side, but monetary policy is supportive here. And just like clockwork, the ISM indicator in the US, the manufacturing index, jumped this week. So, of course, this is a very solid proxy of US economic activity. The indicator jumped for two reasons. Yes, production and new orders are up, but mostly inventories are very low right now. And so there's the tailwind, the macro tailwind from explaining the production numbers, but the low inventories is an interesting signal because we know, we expected the inventory cycle to revert at some point. So US businesses accumulated lots of inventories in late 2024, early 2025 as tariffs were expected. So there was lots of imports going to the US. And then after that, of course, when the tariffs were effective, businesses were drawing down their inventories at a quick pace. So we're expecting that at some point they would have to replenish their inventories. And that would be a macro tailwind because multiple businesses just ordering to rebuild inventories, that's a lot of economic activity. And it seems that we're getting there. So that means that, they will be importing from Canada. So that higher exports for us, that's good. That should push the US dollar down as well. But also, they will be importing from abroad, but also ordering from within. So this should also be a tailwind of economic activity in the US. So that means that maybe the next few months, few quarters, we could have a pickup of economic activity. That should be supportive for growth for 2026. But also, when the economy reaccelerates, that's when you tend to see growth in the markets, growth stocks suffering and value stocks picking up. And this is, of course, part of the story here. So if we look at the tech sell-off, so US software shares extend declines on mounting fears over AI disruption. So that's the Anthropic story that I told you in the opening. And Anthropic's release of AI tools for lawyers prompts massive legal tech sell-off. But it's not just the legal tech companies; it's in the consulting firms more widely, but the software-based firms as well. So now the market seems to be putting a very low final terminal value on any kind of software out there because of Claude Code, which I don't think it's ready for that yet, but it's seen as something that you can just ask it to build software and they will build it for you, customized for your needs. So you don't really need to do business, or you won't really need to do business at some point with those big software companies. So this is the trade here, minus 12% for technology, minus 30% for software. But we've told you multiple times that in 2026 it wasn't a year to be defensive, it was a year to be flexible. There's going to be rotations around. Well, if you go to the next slide here, you see energy up massively, consumer staples up massively. So cyclicals, value sectors, but also there's real world applications here. The US consumers doing well, so consumer staples are rising. Energy, of course, if the US economy reaccelerates, that's good for energy, but also everything that has to do with building those data centers and supplying them with enough energy so that you won't have a pull on the grid and you won't have an inflationary impact. That means that there's lots of energy capacity to be built here. So price of energy is up here. So again, being flexible, rotation, active management in 2026, that's going to be key. And it's been only a month and a week, but it's been quite an eventful month and week to start the year. But already we're seeing signs of this rotation operating here. So maybe just a final word on the backdrop that we had in the market. We still have it, but that's the setup that we've been seeing for a good while. All of this is happening on a delicate backdrop, meaning that the chart on the left, this is from the global FMS, a fund manager survey from Bank of America. So it's the most widely recognized survey in the profession. And they ask multiple questions. And this one, the one on the left, is what's your level of cash right now. And of course, when cash is very low, that means that investors are more fully invested. Maybe they're overreaching for risks in their portfolios. You can see it like that as well. And that gives you an idea that maybe the backdrop is getting stretched or is getting fragile. So we were at an all-time low. All-time goes back to 1999 in this case here, but cash was very low, so that did bring worries of fragility in the markets. On the right, this is the reading of the Fed's sentiments. So the FOMC committee, they of course they give speeches. They're on stage, and there are some large language models here that just analyzes that and extracts the tone. And the tone has shifted to being hawkish recently. So that doesn't mean that they will be hiking rates anytime soon. It's just that, no, you have to start putting into question those two cuts that are priced in for 2026 now, if you're leaning more hawkish. So all of this is playing a role here in adjusting risk sentiment, in pushing investors to ask a deeper question, let's say, about their thesis. And all of this, of course, is leading to some volatility. So the index is still holding pretty well, but as I just mentioned, being flexible in 2026 is going to be key. So what we'll be watching next week in Canada, Bloomberg Nana's Consumer Confidence Index and building permits. In the US, retail sales will be out. Non-farm payrolls, it's not a typo. Maybe you didn't even know, but there was a short-lived shutdown for the US government earlier this week, and that delayed the publication of non-farm payrolls. They were expected on Friday morning today, but they're pushed back to next Wednesday. So I'll be discussing them next week. And of course, the very important CPI inflation numbers, of course, to try to guesstimate what the Fed will do in 2026. And we haven't even mentioned, the next Fed president and what he might or might not do. We discussed that last week, but as you can see, there's lots of risks around the position of the Fed in 2026. So we'll discuss that next week. So it's always a pleasure to serve you. If you appreciate the content here, please share, and of course, come back again next week.